The
start
broadcast is now starting.
this
All
might help.
attendees are in listen-only mode.
Good evening, ladies and gentlemen, and let me make sure you're seeing the right screen here. Here we are. Thank you for waiting patiently as we've tried to overcome technical difficulties. Can you hear me now? Would you please type in the question box whether you can hear me or not? 1, 2, 3. Yes. Oh, good. Keith, Kyle, Mark, Greg. You guys must have endless patience. Alan, thank you. You must have endless patience. We're over 15 minutes late. Totally hopeless. Kyle, good to see you, my friend. Thanks, Mark and David, with us from New Zealand as well. Oh, well, everyone's here. And I do apologize for this. I mean, it's absolutely scandalous. Let me see if I can group myself together and see what the hell is happening. So you should be able to see my screen all right. Terry, you can hear me all right. Is that all good, Terry? Okay, so he says we're all good. Grand. Wow. All right. Well, I'm so glad so many of you waited. I mean, you're endlessly patient. I wouldn't have, but it's a pretty interesting session today, folks. So I'm sure you're going to find stuff that'll get the grey matter thinking a bit, which is what we're always trying to do. And let's get everything organized here. And I want to see what your audience view is. Is all good? Wonderful. Okay. The system is starting to work now. Dean, minus 25 tonight. Oh, my friend. God. Oh, Norbert. Oh, thank you, Norbert. Norbert kindly wrote to me. I didn't do a webinar last week, and he thought I might be ill or something. No, I'm fine. But Norbert's up in Canada. It'd pretty much be about the same where you are. I guess Dean's up your part of the world, Norbert. Minus 25. I mean, I have the greatest admiration for you people who can live in that sort of condition. I don't know why you do it. There must be a good reason. Maybe the cold weather makes beer automatically or something equally exciting. It just sounds ridiculous to me. I can tell you here, I've just had to put the air conditioning on. Not too much, just a little bit of humidity in the air, about 26 degrees, which takes you to, it's about 83, 84, somewhere around that. Beautiful. Short sleeve. It keeps the bugs away. I'll bet it does. Excuse me. Okay, let's get going. Terry's saying, make sure I'm recording this. That's usually the first no. Let me see what this is all saying. Right. $3. Right. So let's just make sure we're with the next part of this, folks, and that is let's see if this screen's changing for you. Can you see the screen change now? You should be seeing markets are rational, orderly, and sometimes predictable. Can you see that change? Ah, good. Kyle, thank you, mate. Keith, yeah, excellent. Thanks, guys. Aren't you wonderful people? All right, well... life in Australia is pretty good. I was going to tell you we were COVID-free for the last 2 months, but there's been a little outbreak in Sydney. Started with 2 people, then 5 people, and it's up to 15 people or 17 people in a day and a half. It's pretty scary stuff, isn't it? Nasty stuff. But in Queensland, which is the Sunshine State, things are great. The ocean's great. The Pacific Ocean is a bit murky today. We've had what we call an East Coast low. It's actually a mini cyclone, if you like, for the last 3 days. I've had to pump the pool out 3 times. I think we've had 27 inches of rain in 2.5 days. I mean, it's just extraordinary. So that's really stirred up the beautiful Pacific, which is usually a perfect blue. Not yet at the moment. It's not full of silt and churn and sand, but it will be pretty nice in a couple of days. Okay, let's move on. I've titled this Start at the Macro, and I'm going to show you some macro charts today, folks, and I'm going to show you some stuff you haven't seen before, it's stuff that I do all the time, but I have to admit, lately I've been focusing far too much on the daily charts, the short-term charts, you shouldn't. And I think by the time you've had a look at some of these new macro charts I'm going to show you, you will understand why it's so important to have an understanding of them and create your own charts. Now, we use, at the Daniel Code, we use 6, 12, and 24-day charts. The reason for that is those people who've done Daniel Code tutorial know that 6 is the minor time cycle. But also importantly, for 160 years, the New York Stock Exchange traded for 6 days a week. And it's only as recently as 1952 that they went to, well, recent if you're my age, I can just about remember that, but I must have been very, very young. Nappies, you say. So the market traded for 6 days a week for 160 odd years, and markets have a memory, these markets, they remember that, the equities in particular. So you're never quite sure whether they're counting a 5-day week or a 6-day week. In any event, we use a 6-day week to create our 6-day charts, and the 12-day chart is effectively the Daniel Code fortnight. Now, I know Greg will like that. His son is very interested in Greg in Colorado Springs, in my using the expression fortnight. It's a very common British expression, very common in Australia. Not used in America much, I guess, but basically a fortnight is 14 nights or 2 weeks. That's a fortnight. And then when we get the 24-day charts, that's sort of equivalent to the Daniel Code month. So don't be too fanatic about that, but that gives you an idea of the depth of what we're doing. So I have to give you a little bit brief update on some of the important times in long-term time cycles. When we're working off daily charts, those of you who watch the Daniel Code webinars regularly know that we are very interested in apogees and perigees, and we're also interested in new moon and full moon cycles. Once we start going to long-term charts, we lose those identifying points. But what we do have is the points that nature itself creates. So basically, the Earth is on a fixed incline of 23.5%. So the Earth holds that position all the time as it rotates around the sun. So it gives the appearance that the sun is moving north and south, depending on the tilt of the Earth. In fact, it doesn't. It's the tilt in the axis of the Earth that makes that happen. But in the process of doing these things, it creates what's called a solstice. In fact, there's 2 of them every year. There's the northern hemisphere solstice and the southern hemisphere solstice. And what happens in the Earth's relativity to the sun is that it goes up to 23.5 degrees north latitude, and it goes down to minus 23.5 degrees south, or 23.5 degrees south latitude. At that point, as high as it will go, or as far north as the sun ever travels, that's called the Tropic of Cancer. And that runs through the southern part of continental United States. When it keeps moving further on, gets down to the bottom end of its arc, it's right over the middle of continental Australia, where I am. So at that highest point it goes to the tropic, it's called the Tropic of Cancer. The lowest point it'll go to 23.5 degrees south latitude. That's called the Tropic of Capricorn. So it's this axis that's constant, that's moving around. It makes it appear as if the sun's moving up and down. In fact, it's not. but you can see the equator is the center line. We all know that. The maximum north that this will ever go is 23.5 degrees north latitude. The further south it'll ever go, right about through the centre of Australia, not far where I am, a bit further north than where I am, it's 23.5 degrees south latitude. So these are points that of time that are created by the cycles themselves. We're not artificially creating these points. These happen because of the Earth's rotation around the Sun. And in between those two solstices, there's a June solstice and December solstice. Excuse me, for you people in North America, or the Northern Hemisphere, in fact, the December solstice is obviously the winter solstice, and the June solstice is the summer solstice. If you're in the Southern Hemisphere, just reverse those things. And on its journey from one solstice to the other, the Earth, at some stage, the center of the Earth, the equator, the meridian point, is directly in line with the Sun. So you can see that how the cycles go. Winter solstice, equinox, summer solstice, equinox, winter solstice. But that angle of the Sun to the Earth is changing because of the Earth's rotation around the Sun. Okay, so now you've got that. We have to have a look at a hypothesis. And the first hypothesis that I started with, one of many, many years ago, but with all hypotheses about trading, you eventually come to an absolute truth. And that is, you put those numbers on a chart and you see what happens. Now, I've been doing this for 30 years or so, maybe a bit more, and there's not a whole lot that I haven't seen. What I can tell you is markets very rarely react exactly to these sorts of events. I mean, if you think about it, why would it matter to a market? Well, in the same way that the apogees, perigees, the moon cycles, we prove over and over again all the time how much they matter. In the same way, there's a gravitational pull with the Sun, which is many, many massive times bigger than the moon. So it's got a much, much stronger gravitational field, but it's so far away that the gravitational field is diminished with time. But nonetheless, in this rotation of the Earth, its relativity to the maximum point of gravity, the maximum gravitational point that is created, is maximum in the for winter in the winter solstice. That's as far north as the Sun ever goes. Allow me to use that term, but understanding the Sun doesn't go anywhere. It's the Earth spinning around the Sun that gives the appearance of the Sun moving north and moving south. So at that point, that's maximum gravitational pull, maximum radiation at the Tropic of Cancer in the Northern Hemisphere, in the middle of the southern part of the continental United States. But that's as good as it gets. From there on, there's a change. Until that stage, it's been getting stronger, 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 stronger. After the winter solstice, as the Sun is effectively moving away from its northerly position, again I state, allow me to say those things, it doesn't in fact. All that's happening is as the Earth is on its cycles around the Sun, the axis of the Earth is giving that appearance. But effectively, it then moves down, it crosses the equator, and eventually, in about June 21, 20th, 21st, typically, it will be at its maximum southern point. It will be over the Tropic of Capricorn. That's over about the center of Australia. And that's midsummer for us. Sorry, that's, let me get my head right. That's midsummer for you guys. No, that's, yeah. When the Sun's at the north, I've got this all round wrong. When the Sun is as far north as it can possibly go, that's the summer solstice for you guys, winter solstice for us. Switch that for the other way around, okay? You can think about that. But once you put all those winter and summer solstice dates on a chart, and this is a 6-day chart. Each bar here is created by 6 trading days. It's our basic short-term version of longer-term charts, if you like. 6, then 12, then 24 are the 3 time sequences we use for long-term charts. Have a look at this. We're looking at, this is the run-up from, you can see the flash crash, and the NASDAQ crash right over the dot-com bubble, I should say, over to the left of this page, down to the low, and then all the way up to the high, the October 2007 high, and then we did have a nice little, what a wonderful market crash down into March 2009, which we enjoyed so much. If you put those cycles on your chart, there is a small probability, a very small probability, that the market will give the appearance of reacting to those dates. So in other words, you can see just underneath where it says 2007, you can see there's a winter solstice that marked that high, that little rally. You can see the next summer solstice is a couple of weeks past the high of that little rally. In fact, what does work, and when that happens, I believe it's only happenstance. It doesn't happen often enough to have any level of proof to it. If you look on that first run down from the dot-com crash, going down past 9/11, you can see there that there's appears to be little highs happening at or very near the summer and winter solstices, but it's not accurate enough to mean anything. In fact, it's random. But what the hypothesis does say, is if these various inflections is the word I'm looking for, these various inflections in time are valid and they are working, then markets will react at Daniel code ratios from those periods. So if you have a look at this chart on the 6-day chart, this is the October 2007 high. That's 207 days from the winter solstice, and that's the Daniel code number. That's 3.5 groups of 59 days. 59's the second number in the Daniel code sequence, very important number. If you look down the bottom where the lows came, this is the March 2009 low, which we had great pleasure calling pretty much to the day and the dollar. And you can see there are 2 cycles there, and they both go to the bar after the low. One's 266 days, or 4.5 59-day cycles. When I say day, it's a 6-day, 49 by 6-day cycles. And also there's 118 days, or 2 by 59 period cycles from the summer solstice. And they've come in at 1 bar past the low. Okay, so that's acceptable, because all of these timing indicators, you've seen us use many different ones, but always on the same theme. They are valid for plus or minus 1 period. And that's because the timing sequence can start either from a chart high, chart low, or the closing high or closing low of that move. And they are sometimes 1 bar apart. So we say that these timing cycles are valid to plus or minus 1 period. So that's pretty interesting if you look at that. Let's move a little bit further. Let's move on now to a 12-day chart. So we're now, this is our fortnight chart for your son, Greg. Okay. This is the 12-day chart of our marvelous and oh so willing S&P. Have a look. It's missing a little bit from the left-hand side. I want to make sure this was legible for you. But the low, the 2002 low came, this is after the dot-com crash, a 62 cycle from a winter solstice, a 70 cycle from a summer solstice. These are all these numbers we keep using: 29, 44, 59, 62, 70, 74, 89. These are all the Daniel code sequences. And the proposition of the Daniel code is that its ratios and sequences will control all markets in all time frames. And if you take the time to go to the Daniel Code website, if you're new to us, there's a link there called Chart Archives. Click on it, be patient. There's about 35,000 or greater number of charts in there, every chart that I've created for the website since we first went public with it in November, December 2008. And you will see that it's very, very hard to find a market anywhere that's turned anywhere except at one of its Daniel Code ratios. So then let's move on with this. We're moving up now to the 2007 high. And we're on the 12-day chart. Each bar represents 12 trading days. Same thing's happening. That high has come in one period past 62 cycle from the winter solstice. It's come in exactly at 70 bars, or the 70 cycle from the summer solstice. And there's more. I haven't put more on. There's more cycles in there. These are the important ones. Look at the low. This is the 2009 low, March 2009. 70 bars or 70 cycles from the winter solstice gave you the next bar. So that's valid, plus or minus one period. That's all we allow for timing cycles. Below that, you can see 59 cycle from the summer solstice gave you that low exactly. And for those of you who've been with us a very long time will remember that at that low, I was running a tutorial in Taupo at the time, and we had blue lines at 666. We had all sorts of good reasons to think 666 was the number that was going to stop it. If you're interested in that, 44,000 plus. Alan, geez, you're a good guy. Alan, who's a tutorial client, has said there are 44,000 plus charts now in the Daniel Code Chart Archive. Hey guys, we've been here too long, haven't we? We've been around too long. Too much work, that. Boy, it's a labour of love. I can afford you. I can promise you. Yeah. Anyway, so here are these cycles, and once we take the Daniel Code ratio extensions from them, we're hitting exactly plus or minus one period at all of these key turning points. And the more of this you see, the more valid it makes the hypothesis for those of you who sort of having trouble getting your head around it. So let's move on. We're now looking at, this is the February mini crash, the little flash crash we had. You can see that this is now on the 12-day chart still. S&P 70 cycle from the winter solstice. Okay, 69 set it off, 70 was the low. 59 cycle from the summer solstice. I mean, do you believe this stuff? You can do it for yourself. It's very easy. You can look up those dates and go for it. Let's move on, and now we're into the really serious long-term charts. This is a 24-day chart. Each one of these bars is 24 trading days. So if you like, this is equivalent to a Daniel Code monthly chart. Have a look if we just test the equinox. Okay, now, I understand perfectly why summer and winter solstices should be important, because they must be vibrations, because they're reversing their polarity at those points. I'm not sure why the equinox should be creating vibrations, but simply to test the hypothesis, many, many years ago, I put them on a chart, and I've kept that chart reasonably up to date, and have a look at it. The low, the 2002 low, came 44 cycles from an equinox. Have a look at this 2007 high, which was incredibly important at the time. It came on a 70 cycle from the equinox, a 59 cycle from another equinox, and a 44 cycle from another equinox. Now, once you start getting into 24-day charts, they're pretty close. They're a monthly chart effectively. You might just be hitting the edge of the month in which the equinox happens. And remember, if you're going to try and mimic this method of timing, if your chart is slightly different to mine, don't be concerned. the default for Trade Navigator is it will create the charts depending on how much data you have, how much data you've actually downloaded. I've got quite a lot of it on markets I'm interested in. You might not have that much, but depending on the first day of when your data starts running from, it will start its count from there. So it could look like it's plus or minus 1 bar either way. So that's the same thing. So that was incredibly important, that high. And the low was equally important. 59 cycle from the equinox. Amazing. 44 cycle from the equinox. Amazing. And as you'll notice with these important swings, you're almost always getting 2 time cycles. Sometimes you get 2 on the same day as happened at the high. You have the 70 cycle from an equinox and a 44 cycle from another equinox. They're on exactly the same bar. The 59 cycle was 1 period early. But interestingly enough, the bar before it, the inside bar, they had a higher close than the chart high. Okay, so that was how this stuff works. Let's have a look at this now. We're still on a 24-day chart, and we're up to the big flash crash. It wasn't big enough for me, but I love a bit of price action, don't you? But this was an incredibly important turn. We've done all sorts of webinars on this, folks. A few that may have missed it. All of our webinars are on the website. So if you go back to end of February, early March, you can just see which webinars we did around there. And I showed you this turn in late February exactly to the day and the Daniel code number, and it was a great bit of trading. And that's a very, very important piece of trading, as you'll see in a moment. So on this really long-term chart, where did this turn come? 62 cycle from a summer solstice, 59 cycle from an equinox, 44 cycle from a winter solstice. I mean, this is not happenstance. You know, happenstance is 1, not 2, not 3, not every high, every low, important ones coming at recognizable Daniel code ratios from these iterations, from these vibrations in time. So yeah, there it is. You can time all that yourself. I've actually got our one of our timing tools on there from the winter solstice. As you can see, that's in December. It says November, it's actually December, and off at December 2021, and off it goes and finds that high, just perfect. The low then comes 70 cycles from the equinox. You can see that there. Now, it's all pretty perfectly perfect, isn't it? Certainly enough to say, over the years, I've proved, at least to my satisfaction, that these internal vibrations of the world's time cycle are valid and they do have effects on markets. And that's a pretty big statement. All right, let's move on. So that's talking about time. What happens if we're talking about price? And we need to know both of these things, don't we? Because we need to know somewhere where this thing's likely to bottom. Well, have a look at it for yourself. Where would you think it'll bottom? There's your 24-day chart. Those of you who've done tutorials know what the Daniel code retracements are. You can put your retracements on from the high of that move in March 2020. Where would you go to? Well, logic would tell you, if what I'm saying is correct, it will retrace to one of these time cycles. In price, it will retrace to one of these time cycles. Have a look at the next chart. There it is. You run that retracement down to the equinox, which I think is marked wrong. Sorry, it's 70 cycle from the equinox to the low. We actually run that Daniel code retracement tool from the swing high in March right down to the winter cycle, the winter solstice. Have a look at it. That little light blue one left of the page. And look where it goes to. 2177.5 was the 59% Daniel code number. The variance is like 3 points. 3 points on a 24-day chart. Pretty staggering, isn't it? Does that stuff happen by accident? No. Okay, that happens because that's part of the hypothesis, and it continues to prove the hypothesis. That itself is not a statement of proof. That's just my comment on it. So, what did you have there at that low? I mean, it was staggering, wasn't it? Most of us as traders thought, well, that's the end of the bull market. The only guy I know who didn't was Frank DB, who's a Belgian gentleman, young gentleman, who came to a tutorial I was running in Taupo back in 2000, and I say 2010, Frank says 2011. He's probably right, he usually is. And he came to see me there, had his fiance with him, Anne, lovely girl. They're married now, 2 lovely children. And he came to me and said, I've never seen a trading chart in my life. I've never read a financial paper in my life. I don't know anything about it, but I love your writing. I was writing a lot of articles for Financial Sense back in the day. They're all posted on the website if you're interested in them. He said, I love your writing so much. Will you teach me this stuff? I said, sure, come to a tutorial and I'll teach you everything. And that was the first tutorial at which I actually taught the 4th seal. It's pretty complex in its entirety, but Frank just lit up over it. He made it his thing, and he became so good at it that I started asking him to help me with the 4th seal analysis. And he's so good at it now that he does it pretty much on his own. He's very, very good, very hardworking, very diligent, and he has got, over the years of doing this stuff for us, he's become a seriously, seriously good trader. And he likes trading bullion, gold bullion, by the Daniel Code number. He's very good at it, I must say. So there you are. What we had there, we had a 59 time cycle. You can see that cycle from the equinox was 59. Price was 59. Time and price are at recognizable Daniel Code ratios. A turn is almost inevitable. You've heard me say that again and again, haven't you? And there was an absolute classic for it. 59 cycle from the high causing a turn. Where would it go to? 59 back to one of these vibrations we're talking about, the next earlier winter solstice. I mean, it various is 2 or 3 2 or 3 points, I should say, out of a number like 2177. I mean, 3 points? That's extraordinary. And it happens all the time. And here's a new way for you to look at your charting. So the thing about all this, the point of today's webinar, is that there's so much information to be gained from these long-term charts. There's so much knowledge. I mean, the charts, if you're using the Daniel Code ratios on which everything vibrates, these charts are teaching you. You learn by doing. All of this stuff that I talked to you about, no one taught me that. I spent years going to, you name all the big gurus in the country, your country, maybe America. I went to all those things. It's very good. Don't ever bet against the example, but I could never make it run as a standard maintainable equity curve. It just wasn't good enough, which is what forced me to go on the desperate search for the Daniel Code that took me years and years and years. But if you're using these Daniel Code ratios, the market will teach you. They're showing you what they've done. Put the Daniel Code numbers on. Ah, look at that. 59 in time, 59 in price. You could also say 70 time to the low. Why is that valid? 70 is a recognizable Daniel Code number. It's not one of our price sequences, but it is a time sequence. And we call it the heathen number. There's nothing heathen about it at all. Actually, it just comes from a different part of the book of Daniel. And 70, of course, was the cycle that Sir Isaac Newton used for his great thesis, Observations on the Prophecies of St. John. You can get it on the internet. It's free. It's published by Gutenberg Press. It's very, very hard reading, but parts of it are, well, you know, the father of modern science. I was going to say quite brilliant. Well, what would you expect from Sir Isaac Newton? Just things that are quite brilliant. It really is. Okay, let's keep moving here. That was pretty nice. Now, so why is that February pullback so important? This is what the Success program did with it. Now, this chart's actually not quite right. I've gone a bar too far on the second leg down. But in 3 trades, the Success on the S&P made something over $42,000 per one contract. Okay, that's like 3.5 times margin. And it's those trading fluctuates between being pretty tough, what I call unarmed combat against poverty, to being absolutely fabulous. I've often said that I used to do a lot of offshore yacht racing, sailboats, big sailboats, 50-foot plus, and long races, Sydney to Hobart, Sydney Noumea, Sydney Hamilton Island, all that sort of stuff. And I've often said that trading's a bit like offshore yacht racing. 80% of it is boring and mundane, and sometimes not terribly pleasant. The next 10% is sheer terror, and that's a bit what some of these big moves we've seen this year in the S&P. Pretty fantastic. But it's those big moves you must get them. Now, if you didn't get it, beat yourself 5 times and get signed up to the 6C or 6S, our daily trading program. 42 odd, I've got 46,000 on that. We actually got stopped out and reversed 1 bar earlier than the low, and then short again into the low. But we made the 6S program made some part about approximately 42,000 per 1 contract, and you've got to have those. When those big moves happen, you must be able to bank them, because that's what really makes your equity curve sparkle at the end of the year. And next year, guys, you're going to see a lot more of that. So make sure you're ready. After Christmas, we'll be giving you an update of the forecast, which was written by Frank DB in December 2019. During this year, honestly, he was the only guy I know who was saying, market's still going to go up and make new highs. Market's still going to go up and make new highs. And he actually put it in one of his weekly 6 seal reports, saying, I know it sounds silly, 4th seal I should say, I know it sounds silly, but this is only a correction because the market's going to go up and make new highs next year. He was strong, and he's right. It's been quite brilliant. And of course, we're going to update you pretty shortly towards the end of this month. We're going to update you with what the outlook is for next year, and there's some very scary parts of it, and you're going to need to know when they are. So if you're not subscribed to Frank's commentary on the 4th seal, you should be. Pick the market you're interested in. He covers gold, S&P mini, and oil. Don't miss what's going to happen in the S&P next year. Okay, so let's move on from that. That was why it was so important. This is a really long-term chart. This is a 24-day chart. I've been showing this to you for years and years, and it's getting a bit crowded at the end here, isn't it? A bit blotchy. Interesting point to note about this is the whole of the UST bonds complex has moved up within the Daniel Code trading channel since 2000. And we've actually stopped moving it up. You can see the thicker red line that runs, there are 4 red lines running through it diagonally. The thicker one in the middle is the mean or the median of the Daniel Code trading channel, which is 1.593 standard deviations from the mean, positive and negative. And this market has just worked within those ranges absolutely non-stop. I mean, it's brilliant. And the big spike a couple of months ago, right to the top of the 2 standard deviations from the mean. Getting support now where? Right at the mean, the median, the thick red line, which is extended by dotted red line. So excuse me, a hay fever starting early today for the afternoon session. So, you know, whoever said work expands to fill the available time, or work expands to fill the available space, was so right. There is so much written about these financial markets, particularly treasuries, US government securities, bonds. I mean, it's a forest of trees if they still use paper. Thank goodness they don't. There's no need for it. This market has been in that Daniel Code trading channel for 20 years. There's the chart, which you've seen again and again and again. That's a really good long-term chart. We should look at those long-term charts more often. But I've shown you some of them in the past. This is a very important one. And let's move on there. So what other benefits do you have looking at them? Well, this is gold in the Daniel Code black line, which is the 89% retracement. That's the last level of support or resistance in any market. And those of you who are with us a lot will remember that before we got to that black line, and I'm going to say about June, I might be wrong, I had backup charts for all of this prepared. I'm going to say July. In July at one of our webinars, which are all there on the website, I showed you that black line and I said, this is in fact the 12-day chart. I showed you that and said a daily close above 1909.2 means we're going to make new all-time highs. Okay, wasn't that exciting? But there's $18,000 odd in that trade simply by knowing that. That's one of the insights you can get from long-term charts. All right, let's see what else we've got for you. Oh, vital stuff. The US dollar index. This is vital stuff for so many markets. It's far more influential than you'll ever realize. So what's happened here is we put that 50% retracement on years ago. You've seen that the market's pulled back 50% from the major swing we were using. More importantly, have a look at the blue lines running diagonally, which is the Daniel Code trading channel, and then it turns into dotted red lines for extension. And you can see that the market back in August 2014 hit that top 1, 2, 3, 4 standard deviations from the mean. Came back off it, tried to hold 2 standard deviations from the mean, went back up and took out the high again and stopped just short of 4 standard deviations from the mean. Then it went down, started to try and find support that 50% line. Since then it's gone up and it's just run along the Daniel Code standard deviation, 1 standard deviation from the mean, all the way along. Now these angles that are on any angle has qualities of both time and price. It just absolutely was holding on, trying to hold on to that line, 1 standard deviation above the mean. And it was doing that all the time, May 2018, right through May. There we are, bop, 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 all the way. And that makes a big high in looks like February, maybe February, March. Find out for you. There it is. It's actually March. It's the weekend. It's the 12-day period ending March the 30th. Look where that look where that bar goes to. It just takes out the previous high. You ever heard the expression "fast moves come from false breaks"? Because this is a classic. That was a false break. It just went out far enough to take all the stops out, and then it reversed, and it's been a fast move down. Look where it's going down to. You can see on its run up, I put the equinox and a winter solstice on here. Isn't that interesting? It's run from a high to winter solstice down to 2 periods before the equinox, but it was hanging down there waiting for time. It didn't just turn around and take off. Then it's run up exactly on an equinox, and now it's heading down. Look where it's going to, though. It's holding right at the 1, 2 standard deviations below the median of the Daniel Code trading channel. This line's the median here, so you can track that through with your eyes. Here you can see how it's been trying to hold this line above it. Here it is, a little break, rallied straight away, Got support there when it went through. It got a bit of support here. Look where it is now. This is 1, 2 standard deviations right here. This is 1, 2 standard deviations below the mean. Okay, so can you twist your head so you can look at it sideways? Look at this, what's actually done. Here it is. It went up. I've just extended the blue line here for you. You can see that's the mean of the Daniel Code trading channel. It's gone up 2 channels on the Daniel Code trading channel, and it's gone down now 2 channels, 2 up, 2 down. Newton's law, every action has an equal and opposite reaction. And have a look a bit further, you now got it running winter solstice down to equinox up to equinox down to winter solstice. Can you believe that? I mean, you can't argue that these things are random, can you? Random walk was the greatest misapprehension of all time. A couple of blokes wrote it. They became great experts on markets, I think, as I recall, particularly the S&P, and said it actually was the way the price moved. It was a random walk, and they got a Nobel Prize for it. I mean, honestly, spare me. There is nothing random about futures market. Okay, so have a look at that. That's just really part of the hypothesis. That's what's happening with the US dollar that is so instrumental in so many other prices. Hello, let's go back. Have you got it now, Terry? Let me go back. We lost audio there. Got it? Sorry, I was talking to you about these charts here and saying how extraordinary that the market had rallied. The blue line I've extended along here is the mean of the Daniel Code trading channel. It's gone up 2 channels from there. Look what it's done now. It's gone down 2 channels and look where it stopped. This is 2 standard deviations below the mean. In other words, equal and opposite. Every action has an equal and opposite reaction. Here we are. This is a blow up of it. I thought that chart was excuse me, so cool. You should see more of it. And it's quite extraordinary, isn't it? And you can see how this whole market since 2017 has been moving directly off these vibrations in time that are created by the Earth rotating around the sun. It's gone from winter solstice at the high in January 2017 down to the low at the equinox, February 18th. Got there a couple of bars earlier, but it hung around down there until that had expired. That's sort of how it works with time. Rallied back up, went into its high, and took out the old high on the equinox, March 2020. Summer solstice, right in the middle, on the blue line. Excuse me 1 minute, folks. That's so much better. I do apologise. I don't know how it's possible to get hay fever when you're 65. I've lived a good part of my life in cattle yards, sheep yards, horse stalls. Never had a problem. I came back from New Zealand 7 years ago and had instantly terrible hay fever. And the variety I've got now is it makes you cough until you sneeze. Once you've had a sneeze, it's all gone. You feel much better. But it's terribly annoying, particularly when I'm trying to speak to you. So I can assure you the most expensive doctors in the country have tried to find out what it is and haven't got a clue. So there you are. I put up with it and accept my apologies. So I want to just show you how powerful this US dollar index is. I know we don't have a lot of time, but this is vital. This is the obvious one. US dollar versus the Aussie dollar. Well, obviously, because the pair is Aussie dollar, US dollar, isn't it? So if one's up, the other's down. And they're perfectly synchronized. So no big surprise there. Same things happen with the Canadian dollar. The two energy, they're called the, excuse me a second. I have to chew a tablet, you'll forgive me. The US dollar, the Australian dollar, I should say, and the Canadian dollar, they're generally referred to as energy intensive. They're both very similar, but same thing. Look how perfectly it's mirrored the opposite side of the US dollar index. Now, that's pretty obvious. I'm sure you all knew that. What's not so obvious is that if you have a look at the commodity index, we used to have a code for this. We're now using the Goldman Sachs commodity index. Who knew that the commodity index was so inversely correlated with the US dollar? Amazing, isn't it? And pretty well synchronized. Only a couple of months out. This is a 6-day chart, so it might only be a month out, the inflection point between the relative highs and lows. But that's why, you wonder why commodities are doing so well? That's why. Almost all commodities, all the ones we trade anyway, are quoted in US dollars. That's where it starts. This is the fourth seal from Frank DB. This is on the S&P. It's been pretty deadly, and this should be the starting point if you're trading every week. Not a lot of people subscribe to the fourth seal. I really would urge you to do so. If you haven't already had a trial of it, drop Terry a note, support at thedanielcode.com. Tell them you're interested in having a trial of the fourth seal. It really is very, very good, and that's just the written part of it. It comes with the charts, usually 6-day, 12-day, 24-day charts, and you can see the cycles coming up, and you can look for them and tick them off as they expire and fail or create a new cycle. So that was his view on S&P for the week. These are updated every Sunday, posted on Monday. And this is his comment on gold. I know we have a lot of gold bugs with us. A lot of people are interested in gold. A lot of people who trade gold. A lot of people who collect gold, all of which are admirable things. So here's the relationship of gold to the US dollar. I saw last week somebody who worked for, of all people, you can't believe it, Dun & Bradstreet, saying, was it Dun & Bradstreet or Reuters, one of the two, who confidently asserted, the textbooks say that gold and the US dollar are inversely correlated. Well, of course, that's not right. The textbooks may say that. Didn't say which textbook. If it wasn't John Needham's textbook, you shouldn't rely on it. But in fact, I've written about this. It's in one of those articles at the Daniel Code website. Gold and the US dollar fluctuate between being correlated and being inversely correlated, which is just a fancy way of saying they switch from working together roughly the same way to being apart, doing the opposite of each other. And that's what's happened here. And here's the inflection point. Right at this equinox here, until then, pretty much equal. Gold's going up, US dollar's going up. This is gold on the top, US dollar down here. They're going up. Not so much in quantum, but noticeably. Then you get this inflection point at the equinox, and it all goes back to the inverse relationship. Here we are. US dollar's going down, 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 down. Gold's going up, 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 up. But it doesn't seem to last, does it? Look how it's petered out here. The dollar's hopefully in its terminal phase. I don't want to see it go much lower. Nor do you, I guess. But it's great for mercantile interests who are selling American products abroad. Lousy for Australia. We're up to about 76 cents now. But these things come and go. But it looks like that correlation's not holding. The inverse correlation's not holding. And I think it's trying to go back to an equal correlation. That's quite significant for gold. So keep an eye on these two charts, folks. These are pretty important for you. What am I trying to show you here? I had something in mind. Oh, just to show you that gold retraced 50% of its dominant swing. We had that target 2091 up there. It hit that. Didn't stay there for long, did it? And it's pulled back to a 50% retracement. That keeps the trend up. There should still be hope for a greater rally in gold, but it's not there at the moment. It's certainly showing signs of weakness. Who knew about this? This is the US dollar and soybeans. You'd think this was gold in its manic inverse relationship phase. Look how inversely related this is. US dollar and soybeans. Okay, they've had a very quiet period. Soybeans have been languishing down the bottom of this chart around that 825, 823 area. Look what's happened since the equinox. I mean, is the equinox such a punctuation point that we should have it on all the charts? Well, it's certainly interesting, isn't it? I mean, the low came here, back here. This is back in March 2018. There's the equinox. This high here, plenty of drama in this, came at the equinox, but more importantly, that's what's changed all the trend. This market was up, the US dollar, sometimes not so strong, other times a bit better. Big blow off top in there, which we've already examined. That's the end of it. Down it's gone since then. But look how soybeans has gone up. Look at that inverse correlation. Did you even know that? You wouldn't have known it unless you looked at long-term charts. The one that always surprises me is this one, copper. Did you know that copper was so inversely correlated with the US dollar index? This is dollar on top and copper underneath. Look at that. I mean, it's nearly as good as soybeans. Might even be better than soybeans. That's a really defining picture of an inverse correlation. You wonder why copper's having a big trot? There's part of the reason right there. Okay, let's move on. Christmas, we're getting to the end, folks. Bear with us. Our final webinar for the year will be on Thursday, December the 24th. And we'll then be closed for the following week, which we wouldn't get any trading in there because it's all holidays and what have you. Now, I know that's going to be an inconvenient time for many of you. Christmas Eve, you'll be at a Christmas Eve party, or you'll be with your family, or you'll be, who knows what you'll be doing, whatever you're doing. I hope you have a wonderful time. But I'm going to do a webinar there anyway, because we always do an end of the year webinar. We talk about what have been the best forecasts of the year. We look at what we said would be the best trades of the year in January, and how they handled themselves during the year and what happened. And we're going to be talking a great deal about the S&P forecast, because Frank DB and the Fourth Seal, I mean, has been bullish all year, including in the big February little mini flash crash. And he's the only person I know who was. I certainly wasn't. But if you look at the long-term charts, it's pretty easy to see. But there'll be a new equities forecast coming soon. And of course, that's going to cover the dangerous days of 2021, which are rushing up on you. So make sure you're subscribed to the Fourth Seal if you need to see the latest annual curve view. Probable all-time high for equities coming. That's it. Fourth Seal will detail it in advance and what follows. Now that's about us for today, folks. Go away and handle my, this is very, very embarrassing, this condition I've got, because recently I've had to go and attend a number of doctor's appointments. Nothing to do with me, and nothing that you need to know about, but just as a happenstance, when you go into a doctor's room, waiting room, now that there's rotten COVID things everywhere, and you start sneezing and coughing, they look at you like, God, get out, man. So I spent a lot of time sitting outside those waiting rooms, suffering from it. And I say it's only hay fever. They don't believe you. Anyway, folks, if you want to be a super trader, if you want to be able to do all the things I've shown you today and over the years, just let me know. Send me an email, jneedham@thedanielcode.com, with your phone number, country and location, so I don't call you in the middle of the night inadvertently, and whatever level you're at in your trading. If you're new, I'll teach you how. If you're already a trader, I'll make you better. And you need determination and dedication. The rest we supply. Here's Website Pro. For those of you who are subscribed to the DC Website Pro, please remember you're entitled to 2 free 6S markets. Let Terry know which ones you want. They're free of charge. Add it to your subscription to town. Try and make your Website Pro subscription even better than it has been. And remember, the trading, the business of trading is making money. It's not being right. The business of trading is making money. That's what we do. Free trials, if you haven't already, you're most welcome. Contact Terry, support@thedanielcode.com, or just click on the link for your free trial at the Daniel Code website, www.thedanielcode.com. And if you have any problems accessing your free trial, let Terry know at support@thedanielcode.com. So that's us for the day, folks. Do pay attention to the disclaimer report. I take it very seriously. I beg and implore you, do not take real money trading until you are absolutely sure you know what you're doing. It's very easy to lose and pretty hard to make. Okay, so that's us, folks. I think that's us for the lot. Jeff, great. Merry Christmas to you, my friend, and to all of you. Mike, Murph, yes, and Alvin. All of you folks, I do wish you a Merry Christmas, and I will have the pleasure of talking to you before Christmas anyway. Thanks for that. John L. down in Coffs Harbour. Hope you haven't got washed away, mate. I think it's either coming your way or gone your way, hasn't it? Wow. What an event it's been. We've had internet problems for days. 500 millimeters. Yeah, very wet. Okay, I'm not up to date enough to talk about rainfall in millimeters, but I reckon I've had between 24 and 27 inches that I pumped out of the pool. A lot of water indeed. That's it, folks. Enjoy your weekends, and I'll look forward to talking to you next week. Christmas Eve, if you're not able to come and join us, it'll be recorded. It'll be posted on the website the next day, and you can look at it any time over your holidays and enjoy that as well. Thank you for your support during the year. Thank you for your patience today when the systems let us down. And it was great that you stayed on long enough for us to be together. That's all for now, and thank you. Bye-bye.